Hello, hi everyone. This is Carla Bustani. I'm a senior solutions advisor. Okay. All right. Hello, hi everyone. This is Carla Bustani. I'm a senior solutions advisor in risk modeling and decisioning. I help customers optimize their credit origination and portfolio management processes.
Thank you. I'm Craig Kestisher. I am a solutions engineer on our customer intelligence practice. So I'm going to be speaking about all things marketing today and customer intelligence 360 from a solutions perspective. And can everyone hear me? Give me a nod. Perfect. Thank you. Awesome.
All right. So today we will explore how banks can optimize their business banking processes, maximizing profitability and return on capital, all while working along the constraints of the portfolio strategy and of market and regulatory constraints. We will talk about the current trends and challenges in the market. We will then see what is credit process optimization. We'll see an illustration of an SME lending process, an optimized one, and then we'll end with a few key takeaways. All right. So let me take you into some of the key conversations we are having with customers, big financial institutions, G-SIBs, Tier 2, Tier 3 banks. The message is consistent. Their credit processes are not what they need, what they want them to be. As a result, however, the conversation is changing somehow. It's no more about risk. It's more about how can we optimize our credit strategy. Look at those KPIs, return on equity, CET1, cost to income. The targets are ambitious. So banks are really going back to basics and thinking how they can achieve those targets. They're looking at areas where they can grow more, where competitiveness maybe is not as aggressive. They're looking at the retail segment. Maybe they can serve the underserved portfolio, looking at areas where markets where they can mature in the retail segment. They're also making that deliberate shift towards SME lending, where margins are higher, revenue is higher. And third, they are looking at how to structure their products in a way that they are more capital light, where it's really fee-based, the way the model is built, so that revenue does not eat into the capital ratios. So this is good, but this comes with attention points. It's not that easy. Many banks have their models there for so many years, the same model, not really representing the customers that are being scored within those models, using those models. At the same time, we have risk concentrations in certain SME clusters in certain households. And those concentrations means less diversification, means inability to absorb shocks. And finally, the needs for refinancing. So whenever interest rates go up, what does that mean? Will customers be able to pay or refinance their loans at those rates? And at the same time, if not, then this is a portfolio, a defaulting portfolio sitting in plain sight. So along those lines, we have market volatility. We have geopolitical uncertainties, we have tariffs, trade shocks, inflation, interest rates that are uncertain, we have competition and so on. So banks have the opportunity to grow, but they need to reduce the cost of risk. That means better models, better decisions, and they need to optimize the portfolio strategy. So what does that mean? This means really focusing on which segments, which geographies. Is it the farming? Is it the hospitality industry? And to what level of granularity should they invest in these segments? Finally, it's cost efficiency. What does that mean? That means digital transformation. Without innovation, without getting rid of those legacy workflows, without getting rid of manual processes, none of this can happen. So there's a constant also, and this is the third column, which is regulations. They're not going away. They're going to be there. And we, with every decision, with every business growth, we have to remain compliant. We have to reduce the cost of compliance, and we have to increase capital efficiency with every single decision we make. So McKinsey has an answer to that concern. And they said that precision, not heft, defines the future of banking. So what does that mean? That means it's not about being the largest or having the maximum large capital. It's about being precise with what we have. So that means being precise with every capital allocation at individual level, at product level, at RWA level, line by line, decision by decision, making sure every decision we make is maximizing return on capital. And yes, basically maximizing return on capital. But it's not just about capital. It's also about knowing when to give the right offer to which customer at which moment. And that means an enterprise customer journey, not a one-size-fits-all onboarding journey or a campaign. Enterprise customer journey where better data feed better decisions, and better decisions ensure customer retention. And those strategies have to continuously adapt to the changing market conditions. Third, according to McKinsey, banks must ensure hyper-personalization. So when we have marketing processes that are looking, or marketing campaigns looking to grow, we have financial and risk measures that are trying to protect. So we have opposing forces. So hyper-personalization is really the key towards building campaigns that are aligned with the risk and financial constraints, and those campaigns ensure that customers convert, that offers are sent to customers who convert, but are also who are likely to behave well and pay over the life of the loan. Finally, innovation. Of course, this is the key towards getting all the above. And innovation is important because, like, when we need to optimize our credit process, we need to optimize it based on the world as it is now, not based on history and just as it was. So the answer to this is credit process optimization. We see banks having all their processes in silos: portfolio management, campaign optimization, the execution process, the strategies are happening in silos, and then when reporting comes, they need to bring up all those different aspects and those metrics together in a spreadsheet. This is difficult to maintain, and this will not generate the goal, the target. So as a result, we need first to ensure the portfolio management is connected to the optimization process, to the credit strategies, and to the execution. When it comes to portfolio management, that means an intelligence engine that really defines the way, not just monitors the portfolio, but also helps make deliberate decisions onto what are the structures, what are the segments that we are willing to invest in, and by how much. Through portfolio analysis, scenario analysis, optimization. And the same, when campaigns are optimized, they must be optimized and aligned based on the portfolio strategy. They must perform all types of analyses to determine the next best offer and optimize the communication. And then the credit strategy optimization is where onboarding, pricing is optimized, early warning signals, collections management. So all those processes must be aligned with risk appetite, with the portfolio strategy, with pricing parameters that optimize return on capital. And then finally is the execution, and this is where every decision is made in the same direction within those same constraints. The most important part of that is the feedback loop. With every rotation around that cycle, we are making better decisions, we are having better models, we are making more precise decisions, and we are reducing the cost of risk and maximizing revenue. Governance and regulations are always surrounding this process. And of course, innovation without governance is risk. So this is key. I will hand it off to you, Craig.
Thank you. And if I repeat something she said, I don't have headphones on. I can't hear you.
Too bad.
So give me just a couple of minutes to explain some of the back end before I jump into the technology side of the demonstrations. I want you to imagine we have a couple teams working together, the credit lending team with the marketing team. And they're going to work together to deliver next best offers to existing commercial customers. Now these next best offers are going to be in alignment with the broader portfolio growth strategy, and they're going to be delivered based off of specific customer signals as you would expect them to do. So let's just imagine yourself in this example. Say you work at a mid-sized agricultural supply company, you're the general manager. You're going to receive a personalized offer, personalized email. Maybe it's related to new term loan top-ups, maybe it's access to additional capital for acquisitions or additional long-term assets. You're going to find that relevant, right? You're going to pause your YouTube video, check your email, and then you're going to call up the relationship manager whose information is inside that email. And you're going to negotiate the best rate, the best price for the offer as you would expect to do. On the other side of that, you'll have the relationship manager trying to do her job and her due diligence, negotiating or taking into account credit risk, pricing and its effect on revenue and the return on capital, all the financial levers that you would expect. You want to ensure smooth efficiency from the phone call all the way to approval to getting the customer their funds. So you're going to have different counter offers you can pull so you don't have to rely on committee approvals. So we'll see that displayed inside the demonstration. And once everything is said and done, we want to analyze performance as you would expect to. Performance from revenue metrics, conversion rates, acceptance, deals booked, return on capital, and all the financial metrics you would expect to have accounted for. And we'll see this all come alive. Everything I described is somewhere along this nice journey you see presented in front of you. And I think we could jump into demonstrations.
Sure. So just to introduce the back end, two different processes are happening. We have a batch process where the portfolio optimization is taking place and is defining the campaign strategy or how the next best offers get presented. And we have a customer intelligence journey that's activating the communication. The second process is the real time. When the relationship manager submits the loan request, we have an on-demand capital and ECL calculation that's taken place. We have a risk-based pricing calculation that takes place in real time, and we have that real-time monitoring of all the different KPIs that we need in order to ensure they bring that feedback loop to improve the process in an ongoing manner. So this is the decisioning tool where we have the credit lending team, the credit strategy team, and the campaign management team working together to build a campaign management process. The first part of the process includes looking at behavioral, financial metrics, financial signals, seeing whether the customer is presenting any early warning signals, doing web searches, industry searches in real time. If any early warning signals are presented, we don't want to present an offer to the customer. So the customer will move to a monitoring process or maybe to some next best action that ensures they don't go into delinquency. If the customer is not presenting any early warning signals, this is where we go into the offers process, where we have different alerts. All those alerts are monitoring or will be triggered based on certain eligibility criteria. For example, a customer might show growth signals, improved turnover in their account activity. And with that turnover, it's probably a signal that their business is expanding. So why not present some offer to them or discuss with them the possibility of financing, let's say, equipment. Other triggers include, let's say, bureau-related triggers. For example, the customer's loan shopping. And based on that trigger, there's a discussion that has to happen to the customer so that they wouldn't go to a competitive bank. So behind each and every trigger, we have eligibility rules. Those are the ones that will allow the alert to show. And there's description. This description will help with orchestrating the communication process. A customer might be eligible to multiple alerts or based on multiple rules. As a result, it's important to surface the right one, let's say based on revenue, on risk mitigation, based on urgency. What gets generated from that batch process is an entire data set of customers and all the offers and a description, accurate description to help the customer intelligence process send out communications as necessary. And now, Craig, what happens after that?
Perfect, thank you. So as you can note, I just want to make, I think you probably said it, but the alert types here, you can see the growth and expansion signals, risk-based restructuring, and there'll also be supply chain if I scroll down. But we'll see that come alive inside of my demonstration. So I'm inside Customer Intelligence 360, and I'm going to start to orchestrate the journey on behalf of the relationship manager. So I'm submitting a prompt, and I'm specifically asking for tasks that I have already created, as well as put in some placeholders for tasks that I haven't created yet. So I don't have everything from my marketing standpoint. I'm going to come back later. So it's going to submit the prompt, plan it, and you'll start to see it auto-create the experience. I'm going to, whoops, hit the wrong button. Let me just, so I just want to pause here. You can see under number 2, we have 3 branch splits here. Next phase of growth, which is the growth and expansion, the risk-based restructuring, and the supply chain. So this is that connection to some of the data coming through from what was just shown and highlighted. So it's going to pick that up and start to create it. And we'll see the 3 branch split right here. So depending on the customer's signals, who they are, what their interest is in, they're going to get a specific email and a next best offer. And we can see it auto-creating, and with placeholders on the far right-hand side. Now once this finishes the build, I'm going to flip over to what I actually uploaded. So this just contains information on the brief. And I'm going to pause here. Look how sloppy my handwriting is. And there may or may not be a guy from the UK, when I shared this video, he started criticizing me. But I have trouble reading my own handwriting, but the agent had no problem whatsoever. And I also use different design techniques with bars and squares and lines in between it. And it understood me. And didn't criticize me either. The agent was nice. So the agent created this customer journey. I'm going to flip now into the audience build, so the data that was actually connected to. I have my audience builder here. I connected it to the Snowflake database, but it can also just been an API over, so I didn't have to do any manipulation if I didn't want to. Just wherever the data is, we can access it and put that customer onto the journey. And just selecting specific attributes. Now I'm going to go into a specific email. So this is what's going to be sent to that specific commercial customer. And I can see here an email built out. Please contact your relationship manager. That guy is quite handsome. I don't know if you guys recognize him. Barbers have been out of business by me lately. But this is the email that's going to be sent off to that specific commercial customer to call up. So he's going to click through and he's going to be in communication with the relationship manager to get this offer. So filling out customer information, segment, the negotiation rate, loan type, loan terms, collateral. You can see here as I scroll down, cash collateral, real estate collateral, as well as personal guarantees. So just putting in all the specific information to get this customer access to the funds they need. So I hit apply now, and I'm going to pause here and let you guys take a skim. We can see probability of default, the return on capital for the desired rate. Right, if it's below the hurdle rate, you have to get additional approvals. So in the bar, or in the chart rather below, we can see the baseline rate. So just room to negotiate to get this loan process approved faster for the customer. And I can see once I go through, right, I can submit, right, a specific amount. I'm going to pass it back over to Carla.
Thank you. All right. So what happened within that second when the relationship manager input the loan information and the results came out? During that moment, two different things have been, in a general way, in a broad way, two things are happening. First, we're assessing the indebtedness of the customer based on their financial obligations and their ability to pay the loan. Second, we are assessing the price. What is the best price? We are assessing the desired rate and also providing a series of best prices for the relationship manager to be able to better negotiate. And those prices are really coming from based on the entire relationship that we have with the customer. The customer may have existing loans, maybe doing investments with us, maybe have savings or employees with salary domiciliations, and we might be generating substantial revenue to a point that we can really be competitive in the way we price that specific loan. So let's go into more details and see how that happens. Within the user interface, the relationship manager will really input the loan information without worrying about any of the existing loan information or anything regarding the customer relationship apart from that specific loan and collateral that we're willing to put. Behind the scenes, a job is run in the background. This is a real-time job that combines different factors. The first part is the credit risk assessment process, where we retrieve the financial information from the database. Those have already been structured in an OCR process, where we calculate those ratios and we assess them based on industry benchmarks, based on policy rules, based on the portfolio strategy and our willingness to grow and how much we can tolerate in terms of risk appetite for that specific industry. And PD calculation. This is based on quantitative, qualitative inputs. We will assess indebtedness and gather all information required for the next part of the process, which is the capital and ECL calculations. So two engines are triggered: capital calculation and impairment calculation. In the capital calculation process, we are really calculating capital at a very granular level, considering client and transaction data, considering collateral information, allocating LGD no matter how complex the collaterals are. And we're calculating based on a workflow that really uses the bank's regulatory capital model. This workflow will run and will generate the capital based on, we can use a baseline scenario and a pessimistic scenario to make sure we are not just generating maybe at the end one pricing option, but generating a more strict and pessimistic rate option. Same for ECL. Expected credit losses are calculated based on the customer's own ECL model. An entire process is fired in the background. The next part of the process will be the price optimization process. And this is where these capital values and ECL values are going to be used. So as part of the process, we prepare data. We check for all the different parameters that go into the pricing logic, and we'll see that. And we'll assess the desired rate. And if the desired rate does not meet the target return on capital, we will suggest through optimization different rate offers or based on different tenors or other conditions if needed. As part of the pricing parameters, we have cost parameters such as operating cost of funds, the tax rate. What is the hurdle rate? So we can be as granular as needed. Over here, I'm looking at different tenors, but we can be as granular as needed, and we can change those parameters as much as required every time our portfolio management process dictates that those should be changed. Now, the next part would be to calculate the return on capital for the desired rate. What does that mean? Taking in all the information, capital, ECL, parameters, operating costs, cost of funds, projected revenue, and all this information, taking them in addition to the desired rate, and assessing return on capital. If return on capital does not meet hurdle rate, we will issue a message and we will label that as, let's say, below hurdle rate or remarkably below. So we will make sure we know where the return on capital for the desired rate is. We will have a segmentation logic then to determine, based on that, what is the approval level needed for that desired rate. Is it the relationship manager who can just go with the application because the rate meets hurdle, or not? Do we need group risk committee for that? And then finally, for presenting multiple offers, this is really an optimized process where a mathematical function will work onto, in that risk-based or RAROC framework, we know all the costs, we know the projected revenue, but what we're trying to optimize is really the rate that gives us the target hurdle rate. So this is what we're doing in that function, and it's running across different tenors so that we present to the relationship manager all the different options based on a baseline and pessimistic scenario in terms of rates that they could give to the customer. And then finally, before we present that rate to the relationship manager, we should align with the portfolio strategy. If the portfolio looks to grow more into a certain industry, we can remove a few basis points to make the rate more competitive. Otherwise, we can add a few basis points that will make it less competitive. In this way, we would be adjusting for the granularity level that we're willing to reach at the portfolio exposure level. And the final piece is really just the output. The relationship manager is presented with an output where the desired rate is assessed with respect to hurdle rate, and they are told that they would need, for example, in this case, the group risk committee approval. Otherwise, you can give other counter offers based on multiple tenor options. It's better to give a rate higher than the pessimistic scenario rate. Otherwise, you can go down to the baseline if negotiation did not allow that. And then finally, monitoring. And this is a very important part of this process, of this AI process. Monitoring the return on capital by different segments, by different industries, by different ratings. Monitoring expected losses in real time by integrating with the data. Checking which campaigns are converting and by which percent. Looking at very granular analysis and making sure this analysis always feeds back into the strategies and optimizing those strategies. A few key takeaways to remember out of this presentation. Precision is really the key. Being precise in the way we are calculating our pricing, in the way we are calculating all the costs that go into this pricing process, having granular models, granular, more precise decisions. One strategy, every decision should align by that same strategy, that strategy that really merges marketing goals with portfolio growth strategy, with regulatory and market constraints. And without seeing in real time, we won't be able to manage the portfolio. So having a real-time portfolio management allows us to optimize this credit process. And finally, digital transformation, which ensures ongoing hyper-personalized communication with the customers. And this is the entire recipe for what is needed to optimize your credit processes. Thank you. Thanks.
Any questions? Does anyone have any questions? I think there's mics in the back.
There's mics.
If anyone, raise your hand if you have a question. If not, Cameron's presenting after us for CI 360 and an awesome new agentic feature.
Can they hear you?
I think so. Yeah. All right. I feel like I'm talking to myself.
I don't know, yeah.
It's